Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about CXAI. So, CXApp Inc. It's a microcapitalization technology firm that has really grabbed a lot of attention recently. They're making a big bet on what they're calling agentic AI to, totally reshape the enterprise workplace. And the stock, well, it's sitting at a really critical juncture, which was defined pretty sharply by that incredible volatility we saw back on December 9th, 2025. I mean, that day it had an intraday jump of about, 21.07%, all because of an announcement about a landmark enterprise deployment.
And that sudden move, that aggressive upward spike is precisely where the conflict is here. When you look at all the material, you see two completely opposed ways of analyzing this. So we really have to ask the question, is this price surge a real valid signal that the company's tech is finally viable, de-risking the stock and showing a path to growth? Or, and this is the other side of it, given the company's background and financial health, is this just transient market noise capped by some really severe structural headwinds, liquidity issues, and frankly, mandatory regulatory pressures?
Well, I'm going to argue that this deployment is a powerful, measurable validity event. I think it fundamentally shifts the entire risk profile. It confirms they have strong product market fit, and it signals sustainable value creation that, allows the stock to finally start overcoming its pretty complex history and that existential risk.
And I'm going to maintain that the financial gravity and the regulatory clock are just ticking way too loudly to ignore. While the news was good, sure, the structural risks, I'm talking specifically about the precarious cash runway and the looming NASDAQ compliance problem, they place a definitive hard cap on any meaningful long-term upside and really mandate an approach of extreme caution.
My whole position really rests on the qualitative data that came with that December 9th announcement. I mean, before this, the market treated CXAI like highly speculative vaporware, right? And that's partly because of its complex SPAC history. That kind of rapid entry to the public market often comes with an inflated valuation and a lot of skepticism. This deployment with a major global investment management firm is the proof the market was waiting for. It fundamentally de-risks the technology, and they gave us granular usage metrics, which seemed designed specifically to address all that skepticism. I mean, consider this, 30,000 engaged user sessions with an 85% weekly retention rate. In enterprise software as a service, that 85% retention, that isn't just a good number. It's a platinum tier proof of utility, of user stickiness. The system is clearly solving a real problem. And what's more, the operational scale is real. 45,000 desk bookings year to date, 96% utilization in flex environments. This is a deployed, scaled-up platform. And crucially, their strategic pivot to agentic AI positions them as the, quote, operating system of the modern enterprise workplace, which successfully aligns the company with what we're calling Phase 2 of the AI investment cycle.
Sure, Phase 2 AI is definitely where the capital is flowing, but only if the companies can actually survive the valley of death required to scale. And that is exactly where the narrative just crashes into the balance sheet. I mean, despite that single compelling data point about retention, CXAI is operating under a financial gravitational pull that makes the recent price action, frankly, unreliable for any long-term valuation. Let's just look at the hard facts from the Q3 2025 report. Revenue for the quarter came in at $1.1 million. Against what analysts were expecting, that was nearly an 80% negative surprise. It's a catastrophic revenue collapse, plain and simple. We can talk about AI strategy all day long, but the financial reality is dire. The company ended that quarter with only $9 million in cash. Now, you couple that with a negative free cash flow, a sustained cash burn of nearly $9.47 million over the last 12 months. That suggests a cash runway of approximately 12 months, maybe less, without some significant, immediate capital injection.
You are focusing on the top-line collapse, which is fair.
I have to focus on the top line because the bottom line is running out of time. And to compound all of this, the company faces a looming regulatory imperative. They got a formal NASDAQ compliance deficiency notice. They have to regain the $1 minimum price by March 10th, 2026. The board has already authorized for a reverse stock split ranging from 1 for 5 to 1 for 10. This isn't some theoretical damage. This is a highly probable action they need to take just to survive.
Okay, I absolutely acknowledge the Q3 revenue miss was catastrophic. It highlights a severe execution problem in their sales department. But that only makes the validation metrics we just saw even more remarkable. The technology is confirmed, the product works, and it delivers value. Now let's go back to the price spike. I see why you emphasize the technical constraints, but let me give you a different perspective on that December 9th move. To interpret that 21% movement as just technical noise, it misses the fundamental shift in investor perception. The rapid appreciation was, at its core, driven by the confirmation that a huge global investment management firm had vetted the product. That validation lowers the perceived risk premium of holding a microcap with the checkered past. It was a classic relief rally, where the market suddenly realizes the worst-case scenario, complete product failure, is off the table. And on top of that, the strategic partnership they announced with Google Cloud lends immediate, institutional credibility. A company trying to raise its profile needs those kinds of blue-chip associations, and the market recognized that credibility injection.
I agree that the news provided the reason for the buying, but that's really only half the story. That's a compelling argument for a fundamental improvement, sure, but I would frame the magnitude of the price move differently. That 21% jump was dictated by market microstructure, not just the fundamentals. If we actually analyze the technical setup, the stage was set for this much earlier. We saw a structural shift happen around November 28, 2025. On that date, the off-exchange short volume ratio dropped significantly, down to 36.62% from a sustained level that had been above 50% for months. This is critical.
Okay, hold on. Could you just clarify for our listeners the significance of that ratio? Why does off-exchange shorting volume matter so much in price discovery?
Certainly. So when that off-exchange short volume ratio is consistently high, usually above 50%, it means market makers and sophisticated players are aggressively using shorting mechanisms, mostly in dark pools, to internalize retail flow. They are essentially fulfilling buy orders, but often selling short off-exchange, which prevents that natural upward price pressure from ever hitting the lit exchange. It's a mechanism that effectively suppresses volatility. So when that high shorting pressure finally lets up, like it did on November 28th, it clears the technical path. The positive news on December 9th then hit, and all that legitimate buying pressure was able to translate far more efficiently into that big 21% move on the NASDAQ. The price discovery here is opaque. It's dictated by this high dark pool volume, which suggests to me it was more of a technical release than a pure fundamental revaluation.
So you're saying the rally was just a function of suppressed pressure finally being let out?
Precisely. If that short volume hadn't dropped, that 21% move might have been a 5% move. The underlying structure amplified the good news. And that brings us to the structural risk that I believe fundamentally caps the stock, the reverse stock split. I'm sorry, but I just don't buy that the NASDAQ compliance issue is just some procedural thing. Let me tell you why. The authorization for a 1 for 5 to a 1 for 10 split, its use is near 100% probable because of that March 10th deadline. And reverse splits are historically viewed as death spirals in microcaps for a very good reason. They don't change the company's valuation. If you cut a pizza into half as many slices, you still have the same amount of pizza. But psychologically and structurally, they signal distress. They often come right before further capital raises or massive shareholder dilution as the company uses that temporarily higher share price to issue new equity. The need to raise capital to bridge that $9.47 million annual burn rate means they are backed into a corner where they have to dilute existing shareholders. And that necessity just caps the upside.
I come at it from a different way because your analysis on the split is accurate. It is painful, but it's necessary. However, the recent rally buys them crucial time, and it reduces the required severity of that split. If they can sustain a price around, say, 50 cents, they need a less punitive ratio, which mitigates some of that negative psychology. But let's look at the financial data you introduced and find the silver lining here. If we look beneath that big revenue miss, we see exceptional operational control that suggests immense leverage. They reported an EPS beat, right? They hit negative 13 cents versus negative 22 cents expected. That points to aggressive, successful cost control. But the real gem is the gross margin for their pure SaaS model, which hit an exceptional 89%.
89% is indeed high, but gross margin only matters if you have revenue flowing through it.
Exactly. That 89% gross margin fundamentally shifts the cost structure. It means every single dollar of revenue they can successfully scale becomes almost pure profit margin. This suggests high operational leverage. And now we know, thanks to the December 9th news, that the product is viable and it's sticky. So if they can successfully execute on scaling revenue, moving from 1.1 million to, say, 5 or 10 million a quarter, the financial leverage is massive. The risk is fundamentally about execution and scale, not about the product being structurally unprofitable or, unneeded.
But scaling requires capital, and the cash is running out in 12 months. Execution takes time, and time is the one commodity they just don't have before that NASDAQ deadline hits.
And this is where sentiment comes back into play, because we can't ignore the powerful psychological factors that provide the sort of bridge financing for these microcaps. CXAI fulfills what momentum traders often call the holy trinity for a potential short squeeze. It's a low-float microcap, it has high AI narrative salience with that ticker, and it has high squeeze potential. I mean, we saw days to cover reach 4.6 days earlier this year. The December news triggered this high arousal positive sentiment across all the retail platforms. This retail enthusiasm, it isn't just noise, it actually drives liquidity. You see users discussing specific technical patterns like Bollinger Band squeezes and VWAP trading. And this injection of transient but powerful liquidity keeps the stock relevant. And that relevance provides management with options, which is critical when you're facing a regulatory crunch.
That's a compelling argument for the temporary momentum, but have you considered that retail sentiment is very often a lagging indicator? The enthusiasm and the volume of chatter often surge after the price has already moved, not necessarily causing it. The current retail coalition is fragile. It's made up of long-term bag holders who are just relieved to see green and pure momentum chasers hoping to catch the technical bounce you just described. Furthermore, the technical trading story here is a little darker than just simple Bollinger Bands and retail excitement. The research highlights some significant spikes in fails to deliver, or FTDs. Nearly 700,000 shares couldn't be settled back in mid-October. For our listeners, FTDs indicate that shares that were promised for delivery couldn't be settled.
This kind of pattern suggests persistent settlement failures in the rolling of short positions by sophisticated actors, which is often an indicator of technical instability or persistent shorting pressure. You can't build a stable floor on technical patterns that are driven by FTDs.
Okay, the FTD data is worrying, I'll give you that. It suggests that while the technical structure was cleared for the rally, there is still some persistent instability under the surface. But that doesn't negate the fundamental validation. The fact remains that a major firm validated the product, and the product is highly profitable at the gross margin level.
And the fact remains that a major firm is running out of cash, missed its revenue forecast by 80%, and must enact a painful reverse stock split in less than 3 months just to survive. It remains a high-risk gamble predicated entirely on whether management can achieve a historic sales acceleration before the money runs out.
So ultimately, I think this debate confirms that CXAI represents a very binary proposition with two opposing forces. On one side, you have the technology. It's validated by the landmark deployment, and it's highly profitable, which we see in that exceptional 89% gross margin. This means the risk is fundamentally about execution and scaling revenue, not about product viability. The December rally confirms that the market will in fact reward concrete, verifiable milestones, buying management the crucial time they need to reach that financial inflection point.
I agree. It is a high-stakes, binary choice. But the fundamental execution clock is ticking very loudly, and the financial gravity is massive. The cash runway is short, and the impending regulatory action, that necessary reverse split, remains an acute structural constraint. The technical momentum from December 9th is likely capped by the inevitable dilution that has to occur to bridge the huge gap between the Q3 revenue miss of $1.1 million and the substantial $9.47 million annual burn rate. The validation is positive, sure, but the need for capital is going to temper any runaway appreciation until that financial vulnerability is fixed.
I think we've successfully illuminated how evaluating a highly speculative stock like CXAI requires understanding the complex interplay between its market structure, specifically the dynamics of off-exchange volume and shorting pressure, and its critical corporate strategy, which is centered on this agentic AI pivot. The full risk-reward profile is only clear when you consider both the technical tailwinds and that fundamental financial gravity at the same time.
Indeed. The key findings here really revolve around the critical validation of their agentic AI technology, the technical analysis of off-exchange volume that helped facilitate the size of the December 9th price spike, and of course, the high probability of a necessary reverse stock split before the March 2026 NASDAQ compliance deadline, all due to their current cash burn rate.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.